Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Thursday, January 7th, 2021. I want to cover three things, the three main asset classes I've been focusing on this week, and that are stocks, equities, major equity indexes, bonds, particularly Treasury bonds, and the current major currencies, namely the US dollar and the euro. I'm going to go through kind of recap what I've talked about recently, but also do some updates and point out I still think some very key developments to watch for and some key developments we already had happen this week. Kind of recap and a quick 10-second recap is the major equity indexes, although they broke down on the 60-minute time frames on Monday, first trading day of the year, there was no follow through on the daily. We never received confirmation or sell signals on the daily. We had bearish engulfing candles, but those come every now and then during an uptrend. And in my book, they need to be confirmed with additional downside, particularly in this case, a break below the lows. That was Monday's bearish engulfing candle. So we never even came close on the S&P 500. We had nothing but green sticks since, and we clearly took out that bearish engulfing. So no sell signals on the equity markets on the daily charts. QQQ got close. You had the bearish engulfing. You came close to the lows, but never all the way down there. That white line is, or the that horizontal line would be at the lows, and we're back to pretty much close right around the top of the bearish engulfing candle. So again, no confirming sell signals there. The fact that S&P has made new highs certainly doesn't help the case. Plus, you want to see, usually within a day or two, you want to see that follow through to a bearish engulfing candle. And right now, we've done nothing but move sideways. So again, no sell signals on the equity markets. Those 60-minute sell signals that we had, there was, we had a couple back tests of the trend line, but no impulsive rejections there. And again, daily charts are much more significant when swing trading. And I'll still maintain if we take those levels out soon, then I still believe that would open the door to the targets that I've laid out. But let me dive into really what I want to focus on in this video are bonds and the currencies. And if you're about to stop the video because, hey, Randy, I don't care, bonds, currencies, you talked about the correlations. Let me just start out with one chart, and then I'm going to get into the levels to watch on these. But this is FXE. This is the Euro ETF, or ETN, technically. It's an ETN. And what I want to show you, I'll roll back here. We're on a 60-minute time frame. Simply compare it to the S&P 500. And so where I'm going with this is we can glean some pretty high probability clues, clues that will give us with a pretty good degree of confidence, maybe a heads up on what the stock market's going to do from here. So again, levels to watch. The stock market was a setup. That setup, later in the day, Monday, after the initial video, I said, look, we broke on the 60-minute charts, but we really need to see these daily confirmed. Those daily bearish engulfing candles, they were never confirmed. So no sell signal there. Bonds absolutely broke down and gave a sell signal below those triangles. I'm going to get to that in a second. The currencies are set up, and that's why I'm doing the video. It's somewhat contradictory analysis. We don't have the sell signal in the euro yet, the buy signal in the dollar, but it could come any minute now, any day now, I should say, and I'm going to go over those charts. What we're looking at here, what I wanted to show you, is the unmistakable relationship between the dollar. In this case, I'm flipping it upside down. You can go to the dollar. I'll do that in a second, but we're looking at the euro. The euro is basically an inverse of the dollar because it is the largest, by far the largest component in the dollar index. The yen is the second largest, and it's still a distant second. You add up the yen and the euro, and that's almost the entire dollar index. The weighting is so high. So, and what you can see here is in white, we have the S&P 500. And in the candles, the green and red candles are the FXE. Unmistakable, especially during times of market volatility. You can see both falling here, both rising. Here we had pretty much sideways trading and slightly up. There was a little bit of a disconnect there, but for the most part, the indexes in the euro moved about sideways. But again, if this doesn't jump out as to an almost perfect about as close as a correlation can come between two completely separate and unrelated asset classes. Again, this is a currency, and this is the euro at that, and it's perfectly correlated with the U.S. stock market. So we might be able to glean some clues that others might see by watching these levels I'm about to go over. And I wouldn't be harping on these so much this week if I didn't think it wasn't significant. So there's the relationship. If you want to see it the other way around, you look at UUP, that's the dollar index. Now you're seeing an inverse relationship. Let me get rid of these lines real quick. And an inverse relationship means the dollar, when the dollar's falling, the stock market's going up. You can see them, and it's a mirrored, pretty much they mirror each other in inverse. Now, another way to look at it, if you don't, that doesn't stand out to you well, is just flip it around. Let's just do, for example, I'll turn off SPY and plug in SH. SH is the the non-leverage inverse S&P 500 ETF. And so now, for those of you that might not be as visual and might have had to study that chart a little bit to make out the inverse correlation, well, when I compare the dollar right here, UUP, to the inverse of the S&P 500, it's about as perfect as a correlation gets right there. Okay, so now that we have that established, it's, I think, safe to assume, although there are no guarantees, I have seen periods where the stock market and the relationship between the stock market and the dollar or the euro does disconnect for a while. So I want to say it's not a perfect correlation on a day-to-day, minute-by-minute basis, but again, the major trends are unmistakable. All right, so let's turn off all the comparisons and dive into the charts. I'm probably going to loop back to the bonds because that is very important. And I'm harping on bonds this week and the currencies because I can say this. I think what happened yesterday, the breakdown in Treasury bonds is, to me, by far the most significant technical event that I've seen in quite a while in the financial markets. It's a solid breakdown. For a while, I've gotten away from doing analysis on bonds. I've talked about how heavy the Fed's hand was in there. But again, and I might do another follow-up. There's some charts I really want to cover with yield curve, looking at the yield curve, the long-term rates ticking up now, my thoughts on that, which I've shared. If this break down in bond prices, which is a breakout in treasury yields, continues, I truly believe you're going to start to hear more and more buzz in the financial media about concerns on inflation. And we do have the CPI coming out next week. I think it's on Wednesday at 8:30 a.m. if I'm not mistaken. It's going to be released, and that's something we want to watch for. All right, now to the charts. Let's start out. Let me get bonds out of the way. Not out of the way. It's very important, but I want to cover those, what's happened there, and then look at the setup right now in the euro and the U.S. dollar. This is UUP on a daily chart. That's not what I wanted to cover right now. TLT. Okay, starting out with TLT. This is the long-term 20 to 30-year Treasury bond ETF. So these are your long bonds. This is comparable to ZB. When I get into the futures, I cover ZB, which is pretty much the futures for tracking the same bonds here. So we'll get into that in a second. And what I've laid out recently in Treasury bonds is this symmetrical triangle pattern. And with the markets giving us those 60-minute sell signals on Monday, I did favor an upside break, but I did mention clearly, before it broke out, that this is energy like a cold spring, and this can break either way, and you need to respect which either way it breaks. And the breakout was more than impulsive. I always talk about breakouts. You want to, it's ideal to see a breakout confirm with impulsive buying or selling. So this is a downside breakout, aka breakdown, and it doesn't get any more impulsive than that. That's a gap down. When I show you the futures in a second, you'll see a very, very impulsive movement. In fact, one of the biggest drops in treasuries in a long time. And why is that important? Because it shows that this wasn't some arbitrary line drawings I put here, that obviously these were key technical levels, and I wasn't the only one watching them. When it broke down, it had a big impact on treasury prices, and that also has correlated with a rally in the stock market. So, uh, well, what can happen from here? Well, let's look at this last triangle right here. At the time, I pointed this out. In fact, I have the screenshot. This was a chart posted back then, and I said right here, the next near-term trend. Here we go. And if you can make that out. The next near-term trend in TLT is likely dependent on which way this triangle pattern breaks. Again, that was back. That was back in. What was that? In December of, where is that timestamp? December 16th of 2019, right before one of the biggest rallies. And again, it's the same premise, that energy building like a coiled spring. So you might be saying, okay, Randy, well, okay, you got that one right. There was the biggest rally that TLT has had in years, if not decades, because that was a market smart money. Whatever, there's forces behind this. For whatever reason, treasuries broke out, and it wasn't at all merely coincidence that they broke out before that big drop in the COVID lows. So smart money moving into there, seeing the risks in the market. Now we've had a comparable breakout, but to the downside. So you might deduce, and maybe it'll be the case, that the next major trend now in treasuries will be to the downside. In fact, until and unless this breakout fails, that's the only logical deduction. That is a breakdown, and it's legit, and it wasn't just confirmed on one day of impulsive selling. We had now a second day of treasuries, and that's a pretty big move in TLT. Remember, U.S. Treasury bonds don't move nearly what the stock market does, unless back here everything was in chaos. The world was coming to an end with all the shutdowns and all that, and you've never ever seen moves like this in Treasury bonds. So that's kind of just this is what treasuries normally do. All right, so technically, what do I think might happen? And this is in part what I'm about to show you in currencies. I think there's a pretty good chance that this breakout may prove to be a fake out. This one was the real deal. And if you recall back then, I was very bullish on treasuries and went long. It's a trade idea on the site. Told you I went long personally. One of the reasons was the markets were in meltdown mode. We caught that on the short side. Now, I'm talking the fourth quarter of 2019. You don't see it here. The stock market was in free fall into the December 24th lows. The entire fourth quarter, they were dropping hard. 20.5% drop in the S&P 500. And what I said at the time, fundamentally, is treasury bonds haven't yet responded to the risks going on in the market, and they most likely would. And that's where we did see, finally, I said institutions will start to sell equities, move into treasuries to protect the downside, and that's what they did. Guys, as I was talking about that, I had to, in my head something wasn't right. I corrected myself. I'm talking about the meltdown in the fourth quarter was 2019, and that's when I made that call. That wasn't based. This was a fundamentally based call. That breakout that I showed you a minute ago was a technical. Here was a drop in 2019 in the S&P 500. That meltdown where the S&P 500 fell nearly 21% in the fourth quarter, and at that point in time, go back to bonds. I was just talking. I was off. This is the fourth quarter right here of 2019. And that's where it was. Back here, there was a case to be made technically, oversold and divergent low. And remember, the market started falling back in, it was early October, I believe, and treasuries were falling as well. And I said, that makes no sense here. Markets are falling. And I remember at the time, it was the sell-off initially was being dismissed by the media. Everything was hunky-dory in the economy. Nobody could realize what was going on, and that's where I made the call and went long treasuries. And that was actually the best buying opportunity in treasury bonds in decades. From there, that bottom, that was one of the biggest rallies. Not that I caught the entire thing, but a good part of it. I think up to here was my price target. And again, it was a fundamental call, mostly because of that reason, that I saw more downside at equities, and that the institutions would eventually have to pull the plug on, pare back on their stock holdings and go into treasuries to help, give them a little stability and safety, and kind of hedge their bets there. So, all right, where are we at now? From a pure technical perspective, the breakdown is legit. I'm going to show it to you on different time frames, a couple different treasury bonds. I'm not going to beat a dead horse, but it's important to watch those time frames. But we do have a price channel here, and we are approaching the bottom of that price channel. So there is some support coming up on TLT, potential support, and we also have potential positive divergence. When I say potential, it's unconfirmed, and I call divergence confirmed when you make a bullish crossover on the PPO and you effectively put in a higher peak or trough, that is, in the PPO right there, and same with the RSI. So right now the divergence is only potential. It's not been confirmed yet. It would be if we reverse soon and you put in this higher low here. That's your positive divergence line, and that would set the stage. That's daily. This is a daily chart, and that could portend a significant trend reversal, which could possibly take us back up, back above the bottom of the triangle. At minimum, a back test, I think, if we can reverse soon. And if we can go up much more than that, then guess what? We take out the downtrend line. Very, very bullish. In fact, extremely bullish if that happens. Why? Well, number one, it would be the breakout of the trend line, but number two, it would also be a failed breakout, a false breakout, probably one of the biggest whipsaw signals in the bond market in many, many years. A big if, guys. I talk about setups. This is something that hasn't even begun to happen. In fact, we just have the breakdown, and I can show you. You can go back in time. TLT, when you look at this chart, TLT trades very well to the technicals, and this breakdown on a scale 1 to 10 right now is a 10. So I'm just laying out something to watch for. Why did I do this? So you can then react if it starts to develop, or if you think that's going to be the most likely case when I get over the currencies in a second. But you can see here, you know, you look for these trend line breaks, and they will often mark major trend reversals. You know, we had a rally, a bullish trend in TLT breakdown that led to this downtrend. Then you had another breakdown here, nice correction. You had a divergent high, you broke this trend line, very sharp correction. Likewise, now look for the same kind of bullish setups here. We had a nice, beautiful bullish falling wedge, positive divergence, and that was a catalyst for this breakout back test and this rally right there. And there was a meltdown into the COVID lows. So we've come full circle right now. Again, those are your major sell signals. This is a weekly chart. Remember that I just flipped over to sell signal, sell signal, sell signal, buy signal. These were early signs to get in on a trend. This was more of a correction here, but these were bigger trends. From here, you didn't bottom until you got here. From that sell signal, you didn't bottom till you got there. From this buy signal, you didn't top till you got here. And at this point in time on TLT, we have a very solid and convincing breakdown on the weekly. This candlestick will not be finalized until 4 p.m. tomorrow, but it would take, I put the odds of it proving to be a whipsaw this week at near zero. There's no way the treasuries are going to snap back up. That would be a, you know, by the close tomorrow, you'd have to go up over 6% to get back above, well, no, a little bit less. Yeah, about 5.5% just to get back there. So let's just say the breakdown looks legit, is legit as of now. Let me be very clear. I'm just throwing out a potential scenario, and this may be the beginning of a new trend reversal, a new downtrend in treasuries. It could take them a lot lower, and that will most likely coincide with a lot more upside in the stock market. So it's a possibility, but there's also some nice support right here about 149 as well. And I can tell you the trend indicator right now is just that we're back testing that zero line. So if treasuries reverse soon, it's going to keep this trend. You know, when your PPO signal line, that white line is above the zero line, the trend's bullish. Bullish trend, bearish trend. A bullish trend, you know, pretty much bullish trend there, bearish trend. And I'm talking about, you can just go up and see that. So that's TLT. All right, I'll rifle through the rest real quick just to kind of confirm these breakdowns. IEF, that's the 10-year treasury. Again, this is a powerful sell signal. Very clean uptrend line, solid breakdown. Just like that here, it was a breakdown, a back test. You started a new downtrend that ended here. You had a breakdown there, a little minor trend line and back test there. Bullish falling wedge, your best buy signal in years right there on the breakout, confirmed with positive divergence. This time around, you had negative divergence on the RSI right here. but you can see this trend indicator right now is still bullish. So I'm laying out the possibility, and I'm very open to it, that this could be a false breakdown. Again, we probably won't know until next week, but we're still in very close proximity to this trend line. So should anytime soon in the next week or so we get a reversal in Treasury bonds and we take out this trend line, well, at minimum, will probably take us up for a back test to the primary trend line. We're not going to go, the upside is very, very limited in Treasury bonds, because when we got here, this was the all-time high, and that was on the meltdown to the COVID lows right here in March, and rates were near zero on the 10-year bond. I mean, I think it was 40 basis points, 0.4% on a 10-year Treasury. Treasuries aren't going to go. It's theoretically possible to go negative, but unlikely. Even Powell said he's very much against going to negative rates. So I just want to say the upside is very limited. But what it would mean is, if this happens, it would most likely coincide with a correction in the stock market. Otherwise, you want to take this breakdown on face value. Absolutely, you can make a case there that this is maybe the catalyst for the next leg up in the stock market and the next leg down in Treasury bonds. So I will continue to update these closely. There's IEF on the daily chart. That was a big level for me right there, that 119.18 right there, this horizontal line, major reaction lows on that level, and a solid breakdown. But there's our uptrend line right there. And so you can see, if I add, let me clear all those lines out on this. Remember, I did this on TLT. This is IEF, the 7 to 10 year Treasury. If we look at it this way, you have that same potential positive divergence, and you're also at oversold readings that usually coincide with at least a kickback rally. When you get down there on the RSI, you can see what's happened in the past. So that's the look at the ETFs and a quick look at the futures. So I've covered this quite a bit recently. ZN, this is the 10-year Treasury bond futures, a beautiful symmetrical triangle. If it broke to the upside, I said you still had some very good resistance at 138, and I'll maintain that. That still is resistance. However, if we were to snap back, again, your first resistance at this point, it's quite a bit up there, would be a back test of the uptrend line and the downtrend line. If we snap back soon, it would come in right around the apex of the triangle, and then that would be your next resistance. So should we get that reversal in Treasuries, those are the levels to look for. Very bullish if we popped back above the downtrend line there, and even more bullish if we get above 138. It may never happen, because, as I said, on a scale 1 to 10 right now, this breakdown is a 10. It doesn't get any better than that. We are at that previous reaction low on ZN, the 10-year, and let's look at ZB, and then we'll move on to the currencies. ZB, got it here somewhere. We were just looking at a 120-minute chart, meaning every candlestick was an hour on that ZN. This is a daily chart here, daily candlesticks on ZB. These are your longer term 20 to 30 year bonds, 20, 25 years, somewhere in that range. And that's the downtrend line right there. There's the symmetrical triangle pattern. There's the breakdown candle. I'll zoom in a little bit. Sometimes forget we're in video mode, and some of you might have smaller monitors. That big red impulsive candle yesterday on the breakdown, and follow through today confirming that, also taking out the 170, 129 horizontal support level. You can see all these previous reaction lows. So again, check marks across the board, sell signals on Treasuries, not just quick swing trading, but longer term. That's a pretty powerful signal if it sticks. And if it doesn't, that's what you want to watch for. Rally back up, that would be a back test, and that could still very much keep the bearish case for Treasury bonds alive if you back tested and then reversed. And the markets are dynamic, and so is my analysis. So if that happens, we'll watch it. And if we continue to waterfall, so be it. This will probably coincide with the stock market just taking off from here and having, who knows, maybe a blow off top or just a strong rally in January, that scenario. But let me show you now. Let me go to the 60-minute chart, and then we'll move on. Oh no, I had it on a 120-minute chart, didn't I? Yes, 6 months, 2-hour candles, and just show you the same triangle breakout up close in ZB. Again, doesn't get much better than that. Impulsive selling. And remember, this impulsive selling came on a breakdown, so it's more significant than this. That's just a period of high volatility when you had these big moves. All right, so there it is. The breakdowns are legit. Now let's look at the currencies and we'll wrap it up. So I started out showing you the unmistakable correlation between, or inverse correlation between the U.S. dollar and the stock market. So now let's just look at what I'm watching. And I like to use the 60-minute charts or the 120-minute charts to kind of hone in and get a heads up on, maybe an early buy or sell signal. Same thing I did with the, on Monday when NQ broke down and QQQ broke down on the 60-minute charts. They were, by most accounts, legitimate looking signals. They just didn't stick, and that's why then you zoom out, you wait afterwards. If you get confirming sell signals on the more important daily charts, then there's a much greater chance that's going to play out for a nice swing trade. All right, so what are we watching on E7 Euro futures right here? That trend line, remember, this is where the exact time, the exact day that the stock market bottom put in a major reaction low on November 2nd. So did the euro right here. So this uptrend line, and I showed you that earlier, I overlaid FXE with the S&P 500, and it was an almost perfect correlation. So again, it's only logical to assume that if this breaks down, it's going to coincide with a reversal in the stock market, or downside. And now this is an untriggered trade setup. I covered this on Monday. This one has yet to trigger an entry. This is the most significant trend line, the lower trend line. You have these reactions again starting on November 2nd, several reactions since, and we're right on the trend line now. The reason that I'm harping on this and doing this, long video again, is it is a beautiful looking setup. It looks to me like this is poised to break down anytime. And if so, I listed a couple targets there, and that would mean a decent correction in the euro. And flip it around, and you want to look at the dollar. You look at DX, US dollar futures, which I do have somewhere over here. Here it is, DX, and DX is primed as well. We had a little bit of a whipsaw in there. This is the trend line that I've been using on DX. You could probably take one like this right now because you have this reaction high. Remember, this is the November 2nd, the same, I think it was November 2nd or 3rd, somewhere around there, around the same time, give or take. That might have been November 2nd right there, roughly the same top. So you can use that downtrend line, we can do that. We'll call it the benefit of the doubt or BOD trend line. Let me just add it right there. Start that point, drag it down here. There you go. There's your BOD trend line. This was the original trend line I had, and I showed a breakout and back testing, the dollar back testing there, and now I've just modified this so you have a parallel trend line. Sometimes I'll notice that when you have a security breakout above a downtrend or breakout above an uptrend, you can draw a parallel trend line and you get that price channel. And that's what this is right here, a price channel, which we just broke out of. So what do we need to do right now? Well, I've added a horizontal resistance level here, about 89,939 right there. Why did I put that line there? Quite a few reactions, including where we're at right now. We had a reaction there today, a couple reactions there, reactions from above, numerous reactions from above and below. So, and it coincides with the that BOD trend line. So that's it. So therefore, if this happens, that E7 Euro trend line will also have broken down. And again, this would most likely mean downside in equities. But let me just say this one more time. A setup is only a setup. It is an untriggered trade. The dollar is in an unmistakable downtrend. There's really no evidence of a bottom. I can make a case for a reversal, but we need to pop it and start to rally and get away from these and start taking out some of these previous reaction highs, especially that 91,081 level. That would be a big level if the dollar can take that out. Right now, it's just an intermediate term or near-term target if we can take out the 80. We'll call that the 90 level right there in the dollar. But again, big divergence building, and divergence is not a buy signal. Oversold is not a buy signal. This is a buy signal, a breakout above that level, and then above the next resistance level, and then above that level. Those would all be buy signals right there. And that's pretty much it. So I'm seeing what continues to look like a nice setup, and I've been talking about it for weeks. It hasn't yet triggered, especially with the FX, or E7 not triggering. The dollar had that little whipsaw, but E7's remained above that primary trend line. For those of you that don't have futures charts, well, you can use FXE. That's the Euro ETN. I would do something like this. Here you could draw a nice clean trend line right there. This is a daily chart, and you can see big positive divergence. This tells me if that trend line breaks, at minimum, we're probably coming down here to that 112, but called about 113 level, and maybe more, because this would indicate a trend reversal. Just like back here, see this little divergent low? Last time that I had positive divergence on FXE, the Euro ETN, was right here, and that was led to the biggest rally that we've had in the euro in years right there. So likewise, I'm seeing an even bigger divergent high right now, and that gives the potential for a big reversal. And then you can use UUP for the dollar. There it is. That's, of course, again, going to look like the euro in reverse. And just like the euro has that bearish rising wedge, the dollar has a bullish falling wedge. And just like the euro had negative divergence, the dollar has positive divergence. And last but not least, you want to take it up one more, Euro USD. That's the Euro US dollar pair. And there's your trend line right there, your trend line that needs to be taken out to trigger a sell signal. And I guess that's don't hold me to these targets right now. I may move these lines around and adjust it. It's more so showing you the trend lines, the major moves that occur in the euro. Here was a trend line right there, breakdown, back test, pretty decent correction. That put in a divergent low right here, which was a catalyst for this rally. And now at this point, we've come full circle with an even bigger divergent high right there. You can go back here, start from all the way back there on those divergence lines, or you can come in nice and tight like this and say that you have this potential divergence building, well, move it right here. Boom, boom, from that point to that point. Either way, that's it. So there it is. The dollar, the euro, they're all sitting right on, key support or resistance levels. They are the euro is clearly in an uptrend, the dollar is in a downtrend, so it's only a setup. But if it triggers and it's impulsive, then again, that may give you a heads up that the stock market, if it hasn't turned at that point, may turn as well. Otherwise, if you are long equities right now and bullish, trend is your friend, and you can continue to just keep an eye on this, and as long as you're above this trend line, then that's confirming the bullish trend in the stock market as well. Okay, if that's not enough charts for you, I don't know what is. We must have covered a dozen different charts, several different securities on different time frames. But again, most of the same things. All I did is look at the stock indexes, and the one I didn't do, did I not cover IWM? Somebody asked about IWM. I saw that on the homepage. I meant to post a chart. IWM broke below this trend line. It's in a strong advance right now. No sell signals there. The sell signals that we had on Monday on the 60-minute chart weren't as clean as the ones on the indexes there. But I can tell you this, I'll maintain this. If we do reverse, you'll probably see a lot more downside in IWM. It's really gotten ahead of itself. On the weekly chart, it's extremely oversold right now, and overbought, I'm sorry. One of the measures I like to use is the percentage above the 40-day moving average. I'm going to park these right here. If you look at the bottom of the screen, this indicator, this line, it's a custom indicator I created that shows how far in percentage terms we are above or below the 40-week moving average. And by the way, the 40-week moving average is the same as the 200-day moving average. I'm on a weekly chart, so if it's a 40-period moving average on a weekly chart, there's 5 calendar days in a week. 5 times 40 equals 200. So this is going to come in at the same level the 200-day does on a daily chart, or the 200 MA. And I'm going to turn my lines back on, and it's going to show you that usually when you get up there about 15% above the 200-day moving average, that's it. That's usually where the rallies stop. This time we've never been this overbought, at least not by this metric in IWM, at least for over a decade. Actually, this is decades here. I'm going back into the yeah, a couple decades in the 2000s as far as IWM goes back, and that's it. So extremely overbought. No signs of a trend reversal right now, especially on the weekly chart or the daily chart. We did have that breakdown, but market shrugged it off. So let me just wrap it up here, and I'll post any updates I see. My main focus right now is on the Qs and to a little bit lesser extent the S&P 500. But like I said, I'm watching those currencies closely, and I'm watching bonds for any, to get any clues to the broad market. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.